This video is going to give you the information about what's actually happening. Banking used to be safe, conservative, even boring. But sometime in the 1980s, all of that changed. Now banking is about trading. It's about using our money to gamble on a huge global basis. Just like going into a casino every minute of every day, this has turned banking into a house of cards. And bankers, they've become banksters who engage in huge fraud, deception, even rigging the markets. In 2008, we had the biggest financial disaster in history, and it was caused by regulators. Regulators failing to regulate the markets, failing to regulate the banks. But the big questions now, really, has anything fundamentally changed since the last bailout? And will this happen again? Will there be another huge financial crisis? What you're going to see in this video is not speculation, it's not conspiracy theories, and it's not just pure conjecture. It's professional banking, academics, lawyers, and regulators informing us that the worst is yet to come, that nothing has fundamentally changed. The next big financial crisis is still to happen, and it will be much, much, much bigger than the last time. You need to listen and learn from these qualified people who know the truth. They have not got vested interest like the bankers and the multimedia outlets. They've got an interest in perpetrating the myth that things are still safe and on even ground while they make huge profits. It's not safe, and you need to be informed and educated exactly why not. We're right around the corner from the biggest financial, economic crash that's ever been seen, and it will dramatically affect every one of us, wherever you are in the world. So let's begin.
Congratulations, Mr. and Mrs. Parker, on your retirement. We'll be happy to cash out your retirement account today. Just a few of the details. Great. Now let me go get your money. There's a little bit more. Okay, 5, 10, 15, 20. That's it. Now don't spend it all in one place.
I believe within perhaps 2 to 3 weeks we will have a meltdown in sovereign debt, which will produce a meltdown across the European banking system. We're not just talking about a relatively small Belgian bank. We're talking about the largest banks in the world, the largest banks in Germany, the largest banks in France. That will spread. It will spread to the United Kingdom, in part through sovereign debt problems in Ireland. It will spread everywhere because the global financial system is so interconnected. They are each all those banks are counterparties to every significant bank in the United States and in Britain and in Japan and around the world. This would be a crisis that would be, in my view, more serious than the crisis in 2008.
Let me tell you something that'll shock you. You know the FDIC, which insures our accounts to $250,000 per person? Well, get ready for a shock. October the 1st, they went bankrupt, and they don't have a dime to back up $43 trillion at this time. It means that they're going to go to the printing presses and create all kinds of new money, but it'll devalue your dollar till it's almost worthless. Now, what's happening? During the United Nations meeting, the G8 climbed to G20, the 20 wealthiest nations in the world that have anywhere from $1 trillion to $11 trillion income per year, expenditures. And that was Australia, Brazil, China, France, India, Mexico, Russia, and many others. And they said from now on, these 20 nations will control everything that goes on financially. You'll have nothing to say about it, and it will not be pegged to the American dollar because it's going down in value. Now, you can believe that that's going to bring some real trouble.
We have more too big to fail banks than we did before the crisis. We have more risky bank behavior, derivatives and other kind of behavior than we did before the crisis. It was a fake. Why? Is it because they don't care? No, it's because at every step along the way, a special interest, a moneyed group, somebody whose view on this was either compromised or extremely pointed in a certain direction, pulled back a little bit. And so that's a serious problem here. We've got a system in the United States that is corrupted by money. And there is no appetite, even though we've just come through big congressional scandals, even though you've got on the left the Occupy movement and on the right the Tea Party movement, protesting a system that's clearly unequal and clearly being run for the benefit of the people who can donate the money to it. There's no movement because a lot of the power has been institutionalized.
It's a little ironic that I would be giving this talk tonight in a courtroom, a venue which is almost wholly unfamiliar to the people who drove this financial crisis in this country, but here we are. When I accepted this appointment in July 2009, I did it with some belief that I had some reasonable understanding of the financial system of this country. After all, I'd been in the private sector for 20 years. As Bill mentioned, I'd been in real estate. I'd been in finance. I had, on my own accord with my partners, raised $1 billion plus in equity and debt. I had been treasurer of the state of California for 8 years, and I'd sat on the board of the 2 largest pension funds in America with $400 billion in assets. But I will tell you that this was a journey of extraordinary revelation. And along the way, I was surprised, I was fascinated, and I was deeply disturbed at what I learned. At times I felt like I'd walked in my local community bank, I'd opened the wrong door, and I'd seen a room as big as the floor at the New York casino. I had no sense of the level of gambling and risk that was being taken in our financial system. And I will tell you that unlike Claude Rains in Casablanca, I was truly shocked. The second thing I want to say is that for all my years in civic life, half my career has been in the private sector, half in the public sector, but I'm not by any means a political naive. I had run 4 times statewide in the state of California. I'd run for governor of the state of California. I was taken aback at the raw exercise of power by the financial institutions of this country. I had some sense, but not a full sense, of the extent to which they wielded enormous power and the crudity with which they exercised that power. And I left Washington more concerned than ever about the sheer power of money as it affects decision-making and public policy in our country. And there was this really fascinating dichotomy, if you looked in the wake of the crisis, between the lack of correlation, in a sense, between who drove this crisis and who has paid the price. It's as if a earthquake had hit and the gleaming skyscrapers at the epicenter of that earthquake were left untouched, and there was rubble strewn all over the place. I think what I am proudest of, and I know that the people on the staff and the commissioners who adopted this report feel the same, is we are now some 10 months after we released our report. And while there have been many assaults from ideologues on this report, as of today, not one fact of this report has been successfully challenged from a point of accuracy. And in the end of the day, facts are very powerful. And this report is truthful in terms of what happened to this country in the years leading up to and during the crisis. First and foremost, we found that this crisis was avoidable. And I say that simply and clearly because the reigning narrative that emanated out of Washington and Wall Street at the time we began our work was that this was a collision of forces bigger than anyone. This was a perfect storm, something that could not have been avoided, a once-in-a-lifetime extraordinary event. But in fact, as we looked at the facts, it's evident that all along the way there were warning signs and there was human action and inaction, not risk models gone awry, that led to this crisis. And I must say bluntly that the CEOs of the major financial institutions and the public leaders who were the stewards of our financial system let us down, and their miss was a big one, not a mere stumble. And for those who say no one could have seen it coming, let me just say loudly and clearly that all along the way there were flashing red lights and warning signs. When we queried Alan Greenspan about his tenure at the Federal Reserve, he commented that he had been 70% right and 30% wrong. To which I reflected the fact that the captain of the Titanic had been right 99% of the time and wrong only 1% of the time. When we queried him about why the Federal Reserve did not put in place tougher regulations to curb the erosion of mortgage lending standards, what he said is when you see unfair lending practices, what you need is not more regulation, but more law enforcement. So we looked, and what we found is between 2000 and 2006, when our mortgage markets were radically transformed in this country, the Federal Reserve referred a whopping 3 cases to the Department of Justice for unfair lending. One related to a bank in Carpentersville, Illinois, one related to a bank in Victorville, California, and one related to the New York branch of Societe Generale. The fact is, the warning signs were there. Policymakers chose not to act. But as if that was not enough, there is now a full-scale counteroffensive underway to rewrite the history of the crisis. Alan Greenspan, who I think in many respects more than anyone led this nation down the path of financial disaster, recently blamed the slow recovery, the nature of our economy, not on the financial collapse which we'd endured, but rather on, quote, he said government activism is hampering what should be a broad-based, robust economic recovery. And he decried, ironically, the frenetic pace of new financial regulations and the current anything-goes regulatory ethos. And let me just say this is quite something. This is the man who drove us over the cliff, and now he offers us driving lessons. And just the other day, someone you would think as learned as Michael Bloomberg spoke out about the cause of the crisis and laid it at the feet, surprise, surprise, of the Community Reinvestment Act and Fannie Mae and Freddie Mac and the U.S. Congress. Either he's extraordinarily ignorant or it is, again, part of a concerted effort to deflect attention away from the true causes of the crisis. And if you look at the statements of every major Republican candidate, they too are deflecting attention away from what drove this country into its current condition. So wages have been stagnant in this country now for 14 years. And one of the most striking pieces of data that I've seen recently is how income growth is now being shared in this country. If you look back at past recessions and the recoveries, if you look in the 40s, the 50s, the 60s, the 70s, even the 80s, you see as we climbed out of recessions, about half the growth tended to go to corporate profits, about half the growth tended to go to wages. As we came out of the dot-com crash, that shifted somewhat to about 70% of the growth as we climbed out of that recession going to corporate profits and about 15% to wages. Since the recovery, in quotes, officially started in May of 2009, 92% of this nation's income growth has gone to corporate profits and 0 has gone to wages. Where do we go from here? I think there are, I don't want to be like Rick Perry, I think there are, I think there's 2, no, maybe 3 things. I got 4 here. There are 4 things that we need to do. The first is the matter of justice. I made the joke today about being in a courtroom in which very few people who participate in this crisis have seen. It's probably the most often asked question I get. Why have there been no prosecutions? Why there's been no justice in the wake of this crisis? It's important that there be thorough investigations, and it's important that where there have been violations of law, there be vigorous prosecutions, not as a matter of vengeance, but to right wrongs. It's the American system of justice. It's important that they occur so that Americans have a sense that we have one justice system, not a dual justice system, one for people of wealth and power and one for everyone else. And it's critically important that there be vigorous investigations and prosecutions because of the simple matter of deterrence, making sure this does not happen again and that there are consequences for breaking the law. Time and time again, we've seen civil settlements where people settle for pennies on the dollar with no admission of wrongdoing and a promise that they won't break the law again. And let me just submit to you for a moment that if someone dropped a 7-Eleven of $1,000, could settle 5 days later for $25 with no admission of wrongdoing, I suspect they'd be back at it pretty darn quick. So this is not a matter of revenge. It's not a matter of cleaning up the books. It's about making sure this doesn't happen again. Secondly, the reforms that were enacted in 2010 have to be put in place, and in my view, they should just be the start of a larger reform effort to ensure we have a stable state financial system. Look, I come from a background of risk. I've been an entrepreneur. I've been a serial business builder, and the American capitalist system is about taking risks, getting reward. There are failures in the marketplace, but the financial system is like the heart of our system. We want stability, and we certainly want stability among the too big to fail institutions for whom we pay the price when they fail. And this consistent rearguard action that's being undertaken by the moneyed interests of this country are exposing us to the next crisis, which is the subject of this conference.
I'm Randy Ray from University of Missouri, Kansas City, which is still in Missouri. Hasn't moved to Massachusetts yet, but we would like to. And the Levy Institute. And I'm part of the Ford Foundation projects at the Levy Institute. What I'm going to be doing is laying out an approach to reforming the financial system. And we base our research on the work of Hyman Minsky, extending his work to analyze this crisis, which we could say Minsky was the father of this crisis, not in the sense that he caused it, but in the sense that he laid the groundwork for understanding the transformation of the economy that finally led to the global financial crisis. And in a way, he saw it coming in the late 1950s, you could argue. How can we reform the system so that, A, it serves a public purpose? And you've heard many of the things that the financial system is doing today that serve absolutely no public purpose whatsoever, so that it can be managed. We do not have a financial system that can be managed right now. And C, it can be rescued in a way that doesn't stink too badly, okay? In the aftermath of 2008, of course, now surveys of the American population, of policymakers, even of Fed officials, tell us that we all think that it stinks, what they did last time. And that actually is what my project is all about, what they did. And sort of a motto, I think, that guides probably all of the Ford projects is, we can't let this happen again. We cannot let it happen again. And finally, the movement to self-supervision rather than regulation and supervision by the authorities. The idea is that these huge institutions can supervise themselves, and we know how that worked out. Anyway, what we then get is also a transformation of the real part of the economy, such that many people probably have seen Larry Summers' speech, and Paul Krugman picked it up. They say we have secular stagnation. The only thing we have going on is bubbles. Michael Hudson, a long time ago, called it Bubbleonia. Many of us had seen this long before Summers and Krugman finally discovered it. they are onto something. I won't go into it. I don't think that their analysis is correct. But anyway, the point is, yes, we have a series of bubbles and financial crises, and each one is worse than the previous one and much harder to rescue the financial system once it occurs. We have studied the crisis response in the United States. What happened was, I'll just give you the one-sentence summary. The Fed had to originate $29 trillion in loans to try to save Wall Street. $29 trillion in loans, and they are not done yet. They had to move on to quantitative easing, and over the course of the past 5 years, they've been giving huge quantities of loans, huge amounts of loans at extremely low interest rates, trying to build up bank capital and to restore their balance sheets.
Good afternoon, everybody. I'm probably going to take a bit of all the buts that were said here and add a little bit more. So to the question of this panel, whether the system is sufficiently resilient, I strongly object to the statement. I'm glad two-thirds of you, or almost two-thirds of you, come in this way. I hope to convince even more of you that that's the case, because it's not just that it's not sufficiently resilient, it's not resilient by any measure. In fact, it's incredibly fragile. And that is not to say that you might find measures under which it's somehow better than some other time. I actually don't think it's that much better as a whole than it was before. By some measures, it's potentially even worse. So too big to fail was mentioned, so let me start there. There are about 28 global SIFIs, systemically important financial institutions. Most of them are much larger now than they were in 2006, so just keep that in mind. They are very large by any standard, just about the largest and the most complex corporations you can find anywhere. And this system is so interconnected that one of those SIFIs, even suspicious of failing, is going to either trigger or be accompanied by more failures. There is no way, there's no collateral damage from that process in the best of all cases. But to see how far we are from a scenario here, let me just give you a few stats on that document. The word should appears 406 times in this document. And sometimes the should is a list of 12 things that should happen. So it's a big wish list of should be things. In other words, that I mentioned very extensively, it's to do with information, authority, legal, law, power, coordination, cooperation, all of those things. I urge you to look at that document. And just remember, the Financial Stability Board has no power of enforcement at all. So all of these are just friendly suggestions to the members. So I asked the panelists here just how many of these shoulds are actually in place. How close are we to any number of these many, many, many shoulds that should happen to get here? Let me give you the IMF's answer from just recently. The summary sentence, as yet, orderly resolution of systemic cross-border banks is not a feasible option. And then there's more statements about the need for political willingness to act, incentives for corporations are weak, achieving progress is proving challenging. So it's been a long time, and I don't see any end in sight to this. So I would argue that progress on resolution is way, way far away from being sufficient. So basically, if you argue that the system is resilient, or certainly sufficiently resilient, you better hope that we're not getting to that point.
Let's play Wall Street bailout. Rule 1, rush the decision. Time the game to fall in the week before Congress is set to adjourn and just 6 weeks before an historic election, so your opponents will be preoccupied, pressured, distracted, and in a hurry. Rule 2, disarm the public through fear. warn that the entire global financial system will collapse and the world will fall into another Great Depression. Control the media enough to ensure that the public will not notice that this bailout will indebt them for generations, taking from them trillions of dollars they earned and deserve to keep. Rule 3. Control the playing field and set the rules. Hide from the public and most of the Congress just who is arranging this deal. Communicate with the public through leaks to media insiders. Limit any open congressional hearings. Communicate with Congress via private teleconferencing calls. Heighten political anxiety by contacting each political party separately. Treat members of Congress condescendingly, telling them that the matter is so complex that they must rely on those few insiders who really do know what's going on. Rule 4. Divert attention and keep people confused. Manage the news cycle so Congress and the public have no time to examine who destroyed the prudent banking system that served America so well for 60 years after the financial meltdown of the 1920s. Rule 5. Always keep in mind the goal is to privatize gains to a few and socialize losses to the many. For 30 years, in one financial scandal after another, Wall Street game masters have kept billions of dollars of their gains and shifted their losses to American taxpayers. Once this bailout is in place, the greed game will begin again.
What we